Welcome to episode 7 of Canada India Insight. I am your host Vipul Jani. Today's topic, investment and wealth management during pandemic, is very unique. On one hand, millions of people have lost their jobs, businesses and livelihoods because of the pandemic. And on the other hand, people that still have good and stable jobs and businesses are offered a different kind of a challenge, and that is what to do with the money that they have. In these uncertain times, should they just put their money under a mattress and sleep over it, or grab the opportunities available today and invest for a windfall tomorrow when the economy rebounds? How to make sure their strategies and investments are safe and sound? We have three experts on the panel today to answer exactly that. They are Mr. Sandeep Goel, President and CEO of ICICI Bank Canada, Dr. Travis Stratton, Chief Economist, Canadian Chamber of Commerce, and Mr. Amit Goel, Portfolio Manager for Hillsdale Investment Management INC. So we'll hear from them individually first, followed by a panel discussion, and then a brief Q&A session in the end, all together for about 1 hour. This webinar is produced by Impact Media and Events Corporation, IMEC, in association with Canada, India, USA Development Forum, CIUDF, and is supported by ICICI Bank, Seneca, Tangentia, Surti, and Hillsdale Investment Management INC. The views and opinions expressed by the speakers during the conversation are their own and do not reflect the views or opinions of their respective organizations. IMEC and CIUDF may not necessarily agree with the opinions expressed, and the conversation is for general information purpose, not for any specific advice or guidance. So with that, let me introduce our first guest for today, Mr. Sandeep Goel, President and CEO, ICICI Bank Canada since April 2019. Prior to that, he was the Chief Risk Officer for the same bank for a number of years. ICICI Bank has 7 branches across 3 provinces in Canada. That's from the last information I have. I'm not sure if you opened up another branch yesterday. So they are in Alberta, BC, and Ontario, and is one of the largest private sector banks in India. Mr. Goel is MBA Finance and Software Systems from Indian Institute of Management, Bangalore, as well as Bachelor of Engineering, Electronics and Communications from Delhi Institute of Technology. Sandeep has leadership experience spanning across investment banking, commercial banking, and retail banking, and is a regular speaker on banking education in leading business schools and multilateral agencies. Sandeep Goel is a member and a board member with prominent Indo-Canadian business organizations. I can go on and on, but I guess that will suffice for today. So over to you, Sandeep.
Thank you, Vipul, and to my fellow panelists. So it's a tough topic in terms of where to invest during this pandemic times, because as a retail investor, I also struggle at times in terms of what is the right strategy. So I will share with you my own investment thesis during these troubled times. And given my background in risk, all my decisions are colored with the risk flavor. So what I would suggest during this COVID time, we have seen a demand reallocation, which has happened across sectors. So just to give you an example, like people are not traveling on vacations, people are not spending money on air travel, but they are spending more money in terms of groceries because they're eating more at home. I was talking to some tea company around 2 weeks back, and they told that the tea consumption during this time has gone up almost 50% because people are staying at home and they are having more tea. So there are certain industries which have benefited immensely from this COVID, and there are certain industries which have got hit. So, in case we are able to find out, like from our own lives, in terms of how we are spending days and how we were spending days, there is a change in consumption pattern. And if we are able to segregate out which industries are impacted today and which industries have benefited today, I think it's a very clear segregation, which I think we all can do. And in the indices, you pick up top 500 companies in US or Canada, and you can find out in terms of which has had a surge in their share price. So you can actually find out which sectors have benefited and which sectors are impacted. So investment options in front of us is to have more exposure to sectors which have benefited. Plus, also look at certain sectors which have been impacted badly, like airlines. We cannot write them off because the airlines are very, very critical for the movement of goods, movement of services. Probably they will take some time to come back on full stream. But stronger airline companies are definitely a good investment option at these times because their valuations are suppressed and it's a good investment option, but only strong airlines because you have to survive this whole time of pandemic. It's almost 15 months or 18 months kind of pandemic time, and people have to survive during this time. So stronger companies which have been impacted, I think definitely should have some kind of portfolio allocation in your portfolio. Plus, I am a very strong proponent. I work with a bank, and I am a very strong proponent of having some money always in the form of a GIC or a fixed deposit, which we call. So you should always have cash on hand, at least 15 to 20% of your portfolio in times of this crisis, because you need cash available. So do a portfolio allocation with a 20% kind of thing in cash, rest in those sectors which I have discussed, and select mutual funds or units which are heavily bent on giving you growth as I think the world emerges out of this COVID. So that is my advice. It's something which I follow very religiously, and happy to engage as part of panel discussion as well as in Q&A. Thank you, Vipul.
Sure. So that's very brief and on the point remarks. Thank you for the wonderful insights, Sandeep bhai. The one especially about the tea. I mean, I have a little bit, of a role there. I used to have 2 cups of tea. Now I have 3 or 4. So that has contributed, in a small sense. So let us now go to our second speaker today, Amit Goel. Amit Goel is a CFA, CFP, MBA. Is a portfolio manager responsible for managing private clients and family offices relationships at Hillsdale Investment Management INC for Ontario and Quebec. Mr. Goel has extensive global investment knowledge with over 15 years as an investment counselor and relationship manager to high net worth investors in UK, Sweden, and China, and most recently in India with HSBC as a senior investment counselor, private banking. Hillsdale Investment Management INC is an independent, partner-owned and client-aligned investment boutique managing over $3.5 billion on behalf of a select group of sophisticated institutional and private wealth investors. So over to you, Amit bhai.
Thank you, Vipul, and thanks a lot for bringing me on this panel of distinguished speakers. And thanks for that great introduction. I've actually put together a presentation, and I would like to share that with everybody here. So just give me a minute while I bring it up.
Sure.
So let's see. Okay, I hope you can look at looking ahead investment ideas. Vipul, if you could confirm.
Yeah.
Okay, great. So I will get going from here. So yeah, so I would like to spend some time on looking ahead and share some thoughts here with you, everybody. So Vipul has already spoken about me. I need to get through this housekeeping issues just to say that today's presentation is not any offer or solicitation, and no material or information contained here should be used for any financial or investment transactions or advice. Uh, Okay, so I would focus on three main areas, and we all know we are very tight on time. So first, I would like to spend some time on market timing. That's a key. I get asked that a lot from friends and clients, how to time the market. Second, I would like to invest some time on investment opportunities between bonds versus equities. And third, equities have already rallied, as we all know, since March. So where is the next opportunity? So trying to look ahead a bit from where we are today. To begin with, I would like to show you this slide of historical market ups and downs. And as you would see across, let's say post-World War II, markets have seen a lot of ups and downs, but most of the times the bull markets, as we call them, lasts much longer and goes much more higher as compared to bear markets. We saw this in global financial crisis when markets went down by almost 50%, but they have gone up by more than 130% over the last 10 years. And then recently, when in March, we witnessed almost one-third market decline, but markets have already bounced back almost 50% from there. So we always see that. And in this context, trying to time the market is very tough. And my next slide will actually throw some light on that. Why is that so? So this chart is showing you over the last 10 years, so let's say March 31, 2010 to March 31, 2020, if you stayed invested, if you didn't time the market, your returns, if invested $1,000 in the market, today your money will be worth $2,700 at a growth of 10.4%. But in trying to time the market, sometimes what happens is that you may miss out the best days in the market. So if you miss the 10 best days in the market, your return will fall down to just 4.3% from 10.4% per annum. If you miss the 20 best days from the market, your return will be hardly anything. So broadly speaking, the 20 best days in the markets actually generated most of the returns. And it is very tough to sit out of the market trying to time it and miss those 20 days, unfortunately. If you miss more, then your returns will actually be negative. So that's why I think the question about timing the market or whether I should invest now or 2 months from now or 5 months from now is a kind of a hypothetical scenario where long-term investors may not gain a lot. Of course, there are certain investors who would like to time the market when it's down, and that's again sometimes not that easy because you don't want to catch a falling knife. So my general suggestion is that for long-term investors, invest in a regular way every month or every quarter, and that kind of takes you home safely and in a stable manner. So that's point number one. Point number two, I wanted to talk about between bonds and equities. How do we choose? So this is a strategy for income-oriented investors. The bond yields have gone down a lot now. So where to invest going forward? So as we all know, bond yields have gone down. Almost 50% of the global government bonds are actually yielding negative returns. So you have to pay to the government to take your money, which is unprecedented. But even after the recent market recovery, one option that we can look at is dividend stocks from large corporates, or dividend yield from large corporates. So there is a chart which I would like to show you here, which will compare the dividend yield versus the bond yield in the 10-year government bond. So this is the chart on the US side, which shows you 60 years of history. And today we are in a situation where dividend yield from stocks is actually giving you a 1% higher return than investing in a 10-year government bond in the US. Looking at Canada, it's even higher. You get 2.7% more through dividends as compared to investing the same money in a 10-year government bond in Canada. So this is really unprecedented. This is for US, we have much higher history, much longer history, and we have to go back 60 years to find a similar sort of a phenomenon. So I think for investors who have a little bit more risk appetite to go beyond pure bonds, they should definitely consider investing in dividend stocks. Um, the other advantage of going into dividend stocks is that you will get a lot of cushion today because of these high dividends. So comparing investing in a 10-year bond versus comparing in a dividend yielding strategy, and just taking S&P TSX Composite as a barometer, the TSX Composite Index will have to go down by 25% over the next 10 years to be a worse off investment. So that has never happened before, that in a 10-year period, TSX has been down by 25%. So I think with the high dividends today, investors have a lot of cushion. The other advantage is that the dividends have been, like if you look at a longer history in US, the US companies have been generally been increasing their dividends over time. And that provides a growth opportunity as well. For Canadian investors, some of them may get tax efficiency by investing in dividends as a stream of income as well. So my suggestion on bonds versus equity will be, if you have some slightly more risk appetite, to go for dividends as a part of your main strategy. Now, looking at strategy for growth-oriented investors, because some investors do not want mediocre returns and they want high returns. So, but since March, markets have already rallied, and they are expecting a level of March or April to come back. We don't know if that will happen or not. But what we do know is, for example, mega cap equities or the top 100 stocks by market capitalization globally, they have gone up tremendously. So if you generally taking out the last 12 years of history, what has happened is the mega cap stock share of the global market capitalization today stands at 39%, which is on the extreme right-hand side. But when we look at the previous 10 years, the average has been between 30 or 32%. But what happens when markets correct, like what happened in 2008-9 financial crisis? A lot of money chases these large stocks, and that's why their share of global market cap goes up. We have seen that in 2008 and 9, and we are seeing that again now. So I think there is a point to be made here that what we need to look beyond these popular stocks, which in the current space, for example, are the tech stocks like Apple, Google, Amazon, etc. And we have already seen in the month of September how these stocks have corrected a lot. Around 10, we have seen a 10% correction in NASDAQ. So that was the writing on the wall with this kind of high allocation and too much money chasing too few stocks. So where is the opportunity for investors? I believe we should look at small cap equities across the globe in the US and in Canada. Taking US again as an example, because we got a longer time history in US, this is a chart showing you the 12-month return of small cap equities versus large cap equities just after the market bottoms out. So there are 5 big corrections in our lifetime that all of us have witnessed that I would like to show here. So in July 1982, after the markets bottomed out, the small cap equities went up by 95% versus 59% of large cap equities. After Black Monday, small cap equities again outperformed. After dot-com bubbles, small cap equities again outperformed, and so on. After the big financial crisis in March 2009, 1-year return in small cap equities was almost 100%. And in the recent times, we have seen that because we are still only 5 months into the recovery, the large cap stocks have got a lot of attention and they are tying with small caps. But I think going forward, small caps have a much more potential to outperform large cap equities. On an average, small caps outperform large caps by a ratio of 50%, like between, like in absolute terms, around 70% versus 50% of large cap. So I think there's a case to be made here for investors to start looking at small caps. Also because on a much longer term basis, if you see, this is a history of last 95 years since we have data for US, that small cap equities have generated a return of 12% per annum versus large cap equities which have generated a return of 10% per annum. And that translates into huge amounts of absolute money difference when you compound these returns over longer periods of time. So small cap equities have shown results on a longer term basis. They have shown results just 1 year after into market correction. And what makes it the most exciting piece right now, why I'm suggesting to investors to look at it is because over the last 2 years, small cap equities have actually underperformed. So this slide shows you how the small cap equities are currently underperforming large cap by almost to a tune of 20%. And that's a huge gap, which is unprecedented in the last 20 years, just because too much money is chasing too few stocks in the large cap sector. This segment of the market has got ignored. And I think there's a huge opportunity for investors to look at it at this point in time. As we have seen before during the recoveries, small cap equities have been outperforming large cap equities by a much higher margin. So I think just as a matter of point, some investors might say that small cap equities are much more volatile, and but even on risk adjusted basis, they outperform. And the other advantage of small cap equities is that a lot of M&A activity that is happening already, and that is going to happen because of cheap money everywhere, is gonna be the small cap are the companies which are the targets. They are not the acquirers. The acquirers are the large cap companies. So they are the small cap companies always get acquired at a much healthy premium from their current share price, and that generates a lot of return for the investors in small cap equities. So that broadly finishes my presentation. So in summary, time in the market versus timing the market creates successful investors. Interest rates on bonds are at very low levels. And I have suggested two investment strategies. For income-oriented investors, they should consider dividend stocks and a basket of dividend stocks, which provide cushion against market corrections. And for growth-oriented investors, they can look at rotating some of their large cap equities into small cap equities. And thank you. And your feedback, your questions are very welcome, and happy to be in touch going forward.
That was a fantastic presentation, Amit bhai. Thank you very much for that. So that brings us to the third speaker for today, who is no stranger to these presentations and charts and everything. He has been writing guest column in Canada India Insight publication, and also spoke at the IT conference that we organized last year in May in downtown Toronto. That actually launched Impact Media and Events Corporation. And since then, we have done several conferences, 2 gala events, and now a big Canada India Insight conference coming up on the 30th. And the publication, of course, has started since then as well. So Dr. Travis Stratton is the chief economist for Canadian Chamber of Commerce. He is an award-winning business economist, and is an advisor to both private and public sector leaders. He has counseled senior corporate executives and policymakers around the world. His research is taught at Harvard University's Kennedy School of Government and the Center for Homeland Defense and Security. Travis Stratton studied at Carleton University and Graduate Institute of International and Development Studies in Switzerland. He was head of economic development for BDO from 2015 to 2018, as well as chair professor of international studies at the American University in Dubai. He is currently based in Ottawa. So over to you, Trevin.
Thanks, Vipul. And in terms of, to pick up on the previous presentations, in terms of timing the market, what I thought I would do is give a bit of an outline of what the economic projections are for recovery for a macro perspective for macro investors. So I believe that we've entered the second phase of the pandemic, or at least the economic aspects of the pandemic. The first phase was characterized by us basically putting our economy into a medically induced coma by placing restrictions on businesses and individuals, and obviously a number of different emergency subsidies going out as well. What we've now entered is businesses starting to reopen, and provinces and territories within Canada starting to reopen their economies to varying degrees of success depending on what sectors businesses are in. So we've certainly seen a rebound in jobs. We've gotten back about 2/3 of the 3 million jobs that we've lost in Canada. We've seen a rebound in consumer confidence. We've seen a rebound in real estate markets in a lot of cases as well. But what is characterizing this second phase of the pandemic economically is not necessarily the restrictions put in place, but our economy operating below capacity. And so to get back, for instance, those last third of jobs, or generally we're still about a third away from where we are pre-pandemic economically within Canada, we're going to need to put in place certain policies for growth and for job creation. The initial rebound from reopening is now starting to peter out, and it's not going to get us back to normal in and of itself by reopening. So if we're looking ahead at the economic projections, Canada's growth rate next year is supposed to be significantly high, though it still won't get us back to normal. We're looking at somewhere over a 5% growth rate, which is obviously big for Canada. But we still won't get back to where our economy was prior to the crisis until at least early 2022. And of course, there are a couple very important variables there as well. First of all is whether there's a second wave. If we're looking at the COVID numbers right now, that is still a question mark that is out there. And then secondly, if and when a vaccine will be developed, which can obviously accelerate the recovery process as well. Though if it's not created within Canada, then there's also the question of when Canadians would be able to get access to it too. But what we've really seen right now is that the rebound that has taken place has had a different impact in different sectors. So, I don't like the terms old economy and new economy. I think it's a bit of a false dichotomy. But, we do see a rebound taking place in, the new economy companies, technology, financial services, intangible assets, if you will. And the rebound has been much faster for those. Where we haven't seen a rebound are in some of those sectors that almost require physical presence for their business models to work. Restaurants and food services, the energy sector, which is obviously having a whole other impact because of what's going on with prices as well. Tourism, certainly, definitely transportation, specifically with the airlines. And initially retail, though the retail sector has been able to transform itself through technology and e-commerce much faster or had much more opportunity to do so than some of those other sectors that I mentioned that aren't doing as well. And so, this is what a number of economists call a K-shaped recovery, right? Where some sectors are rebounding and growing and other sectors aren't. And a number of the jobs that have been lost in those sectors that aren't has created almost a skills gap in the economy, where the sectors that are growing, the skills that they're demanding are not the same as the skills that are available in the labor market right now of the people that still haven't been able to get their jobs back. And so this is also having an impact on the economy as well. And so I imagine that this is partially, usually in economic downturns, and I'm a student of economic history and financial history, usually in economic downturns, I recommend investing because it's if you're a long-term investor, it's a fire sale in some way. But because we actually see the markets not necessarily following the path of the economy right now, it's much more complicated. And this is a different type of economic and financial crisis than we're used to. If we look back to 2008, if we look to 1929, the catalyst was a financial crisis that then had reverberations throughout the real economy and resulted in an economic downturn. The catalyst for this was not a financial crisis, right? It wasn't the misallocation of assets in our economy. I'm not saying that there might have not been issues in the financial sector or in the economy as a whole, but it wasn't the catalyst for it. It was a pandemic itself. And so that's why I think one of the interesting aspects is how the rules that we know about investing in the economy during previous downturns, how they still apply in this current context, and what variables we actually have to take into account that might be different this time around. And then apart from all of that I've mentioned and the sectoral impact and potential opportunities there, and as some of the speakers mentioned, quite a bit of the value of markets is in intangible assets right now, which might explain the deviation between markets and the economy. But apart from that, I'm also very concerned about debt levels that are being taken on. Public sector debt, household debt, corporate debt. Certainly interest rates are low, and so it can potentially be an opportunity to borrow. I think within Canada in particular, we have to keep in mind that interest rates don't always remain low, right? If we do have quite a bit of public sector spending, and if the economy does grow at a higher rate next year, and if consumer confidence is still high, or people have saved quite a bit so far, and we'll see if they actually spend that once subsidies run out, then that can be a recipe for inflation. A big question is whether inflation will ever go above the 2 to 3% target for Canada, and whether that will require, or that will put the Bank of Canada in between a rock and a hard place on making the decision whether to keep interest rates low, which could obviously spur growth and job creation, versus trying to address inflation by raising interest rates and then placing a greater debt burden on everyone that has collected debt during this period. And so that's going to be a very interesting question going ahead. And so maybe I'll leave it at that, Vipul.
Yeah, thank you for those insightful remarks. That brings us to the second part of this webinar, which is a panel discussion for about 15 minutes or so. I will pose the first question to one of the panel, and then any of the three speakers can ask a question or make remarks, and the other people can pitch in. So my question for all the panelists is, since this is a Canada-India Insight platform, if I have to compare Canada and India in terms of investment opportunities, growth potential, and safety of my investment, what are my best options in both countries and why? We'll follow the same order, starting with Sandeep.
Mm-hmm. Yeah, so I think, see, it is directly linked to the expected growth in these economies. I think COVID times are slightly different because I think we are seeing contractions across India as well as Canada. But on a long-term basis, I feel from a growth point of view, like Amit has mentioned, in terms of if you're a growth seeker, then I think India offers much better opportunities. And if you're a dividend seeker, probably a more stable economy like Canada offers you good options.
Okay, Amit.
Yes, so I moved to Canada just 4 years ago, and I think I can relate a lot from my own experience. So I continue to be invested in India. It's an amazing growth story, and it will continue to be a huge growth story. I think if you look around yourself, all the large MNCs corporates, they are setting up shops in India. And that's the next key market for everybody with more than 1 billion consumers. Even if you look at the top tier of the market with middle income or higher upper income class, we have more than 300 to 400 million consumers, which is like the size of the US. So everybody in the corporate world is looking at India as the new world, and trying to make maximum returns out of India. So there is no doubt about that. But when I moved to Canada, and when I look from a Canadian perspective, of course, there are issues regarding the ease of doing business, the ease of investing in India. And of course, institutions like ICICI Bank have been really, really helpful. I'm a very satisfied and long-term customer. And I think all Canadians need to use these institutions to the best of their advantage. From a Canadian investment perspective, I think what I see the difference between, I would expand the scope and say North America versus India. And because we have option to invest in USA very easily from here. When I was in India, I was always used to aspire to invest in tech stocks, for example. For example, India doesn't have too much of high growth tech stocks. It has a huge amount of consumer stocks and financial stocks. So the Indian Stock Exchange, which I happen to know very, very well, is focused on consumers and financials, and a reasonable amount of healthcare too. When we come to Canada, we are looking at cyclicals and banks. So we are focused on energy and financials. So what happens, India is a big consumer of energy, and Canada is a big exporter of energy. So as an investor, you can use these two angles very easily. Like if oil price goes up, it benefits Canada, and if it goes down, it benefits India. So that's a big sort of strategy that investors can apply. And then looking at USA, that's the place where all the big tech stocks are listed. So for your exposure to tech stocks, there is, I think, the best place to invest will be the US, and will continue to be. So I think as an investor, you need to make sure you are investing judiciously and allocating your money wisely between Canada, India, and the USA, and you will perhaps be getting a good mix of growth, stability, and long-term.
Sure. So as a trilateral body, Canada, India, USA Development Forum, I guess we are uniquely positioned you know, to work on that front. Okay, so Trevin.
So I think a lot of it will depend on what the policy response is of the respective governments. And I can't necessarily underscore that enough because there are, a lot of moves taking place, not only within these two countries, but in other countries as well, where we don't necessarily know whether the response will be business friendly, will be friendly towards the economy or not. And so that's a big question mark that's out there, I would say. Generally, so I think in terms of the global economic picture, what we've seen right now is a bit of a reversal of the globalization that we've seen for many decades, the economic globalization. Global capital flows are down since 2008. Global mobility is down too, right, in terms of labor mobility as well right now. Whether that started in 2008 or 2016 or now, it's certainly been accelerated by the pandemic itself. And so one of the big questions to me is whether this means that national economies like Canada and India will, go from being globally connected towards being, more national economies, or whether it will result in regional economies, whether global supply chains will turn into regional supply chains in North America and Europe and Asia, and whether this will apply to all sectors as well. I think certainly we'll see a move towards probably more domestic manufacturing with nearshoring and onshoring, potentially move more towards domestic agricultural production for food security. And that would specifically impact Canada and its relationship with India, because obviously there are a lot of export opportunities for Canadian agriculturalists as well in the global market. And so this is a big question going forward. But when it comes to the policy response itself, it will depend on whether governments put in place the business-friendly, pro-growth type of policies that will be necessary to get the economies back to recovery and back on track. And make no mistake, globally, it's going to be a much more competitive environment for all countries. It's going to be much more zero-sum, the global economy. And so that will require very competitive policies to be put in place to be able to compete in that environment. And that will certainly impact any investment opportunities.
Fair enough. Okay, so then now it's open panel. Feel free to ask any question, make your remarks. Anyone can jump in.
So I'll go first, Vipul. I'll have a question with both Trevin and Amit. I think you come from the investment community. So what is your view on this oil price? Because see, what we are seeing is there is a unified contraction in demand for oil, as I think travel comes down, at least for leisure. And what is your view on the oil price? Like, is it going to strengthen and is it going to benefit the Canadian economy, or the oil price will remain soft?
So it's a very complicated question, specifically for the Canadian economy, obviously, considering how big our energy sector is here and how it used to be bigger as well. I think there are a lot of different questions involved, and I'm not sure that we necessarily know the answer right now. So I do think over the long term, demand for energy will still be strong, and the ability to replace it with renewable sources is going to be limited unless we can figure out the storage issue for renewable energy. And also one of the factors involved is that certainly, some like jet fuel is one of the types of fuels that you can't replace with renewable sources just yet, other than some experiments that are taking place. But the impact that we're seeing on the airlines right now is probably dampening oil prices as well. And so it will depend on whether that sector actually comes back to whether that demand will come back. think a lot of it will depend on, first of all, the policies put in place for energy, oil and gas companies to transform themselves, because the amount of investment it is going to need to take to, for instance, achieve our 2030 goals or achieve net zero emissions by 2050, that's a lot of money that's going to need to be invested. And some of these renewable energy startups just might not have the amount of capital that some of the larger oil and gas companies have to be able to invest in what's going to be needed. But they are going to need, within Canada specifically, getting rid of some of the regulatory burden that has been put in place. And certainly, you know, all the energy companies that I talk to, you know, they believe that climate change is a real issue and the business community has a role to play in addressing it. They are just looking for a business-friendly way to do so, to invest in the things that are needed. You know, not necessarily getting rid of regulations, but improving, for instance, things like the Clean Fuel Standard, not necessarily, you know, getting rid of carbon pricing, but when you layer regulations on top of carbon pricing, it defeats the purpose of using a market mechanism. And so things like this are going to be big questions that all governments are going to be responding to from a policy perspective. And certainly we've seen many economic recovery plans, potentially in Canada. If we look down south at Joe Biden's economic recovery plan, it's certainly a green plan. We see it in South Korea as well. And so there will definitely be a big push for this as an aspect of recovery, but it'll depend on the specifics of the policies put in place.
Amit, any views?
Yeah, I think the one factor that I would look at is pure economics of demand and supply. And as Trevin mentioned, the demand is in the short term definitely picking up, and we are expecting hopefully airlines to come back into business. But when we look at long term, so in the short term, I think it's gonna sustain where it is, and it's gonna continue to have a slightly upward journey, I would think, as we are seeing in a lot of other commodities with increased demand across the globe. In the long run, again, it's a factor of impact of climate change, impact of government policies, and how the supply equation also builds in, because we have seen a lot of supply can come on board very, very quickly, which is right now in a passive state. So I think in the long run, I would not be expecting a huge upside to energy, but I think whether we could see the energy sector in Canada to kind of look back at very, very low prices, it's a tough situation to go back in. But I think a lot of Canadian businesses are getting adjusted themselves to the new reality of the volatility in energy prices by reducing the leverage in their balance sheets, or by making sure the investors are aware of the risks and making sure that they are contributing themselves to the climate change risks facing all of us. So I think the Canadian energy sector is really taking on the challenge very, very well. And we see it in the way the valuations and the stock prices of some of these stocks in the energy sector have bounced back. We are very confident that the Canadian energy sector is ready for all these challenges going forward.
Yep. And I believe Canada is now reaching a point where soon it may have more people who are retired than people who are in the workforce. So when we discuss about all this wealth management and investment and whatnot, primarily we talk about people that are already working right now. But what happens to people who are retiring or retired, have some money, have some little money? You know, what options do they have? I believe Amit Bhai certainly had something to contribute to that topic. So we'll start with him then, and then come to Sandeep, and then Trevin.
Thanks, Vipul. Yes, in my profession, I come across a lot of investors who are about to retire, or are retired, or are semi-retired, and are looking to create cash flow from their portfolios. So without going into specific strategies, because every investor has his or her own strategies, I would like to highlight two key tools that I would use for such clients. One is create a very, very robust financial plan and trying to forecast. Typically the retirement lives can last 25, 30, 35 years. So the investor should have a view of going forward. How is their portfolio going to last them for a period of 30, 35, 40 years? The way I suggest to run that scenario is through not just assuming that market will give you an X amount of return. Let's say typically people assume a 5%, 7% return on their portfolios, but that's not realistic because markets go up and down all the time. So what we do is we provide our clients with something called a Monte Carlo or a scenario analysis, where we run 500 tests on the portfolio or on the financial plan to see the resilience of their portfolio in tough times and in good times. So that provides investors with a lot of confidence in terms of, yes, I can retire at this point in time. I can withdraw this amount of money from my portfolio without running the risk of running out of money, even if market goes down tomorrow. So that's one tool. The second tool is that a lot of investors want to say, okay, I need X amount of money every year, like maybe 4% of my portfolio, 5% of my portfolio, something like that, or $50,000 or something. Our answer to that is that you need to have some sort of shock absorption, or something we call technically a snake in the tunnel model, which means that in a good year and a bad year, you need to adjust your withdrawals from your retirement pool to make sure that you're not over withdrawing or you're not under withdrawing. So if markets are up in a given year, instead of withdrawing 4%, you may withdraw 5%. But if markets are down, instead of withdrawing 4%, you may actually withdraw 3%. And you should have that sort of a shock absorption sort of a mechanism to sustain your investment plan. You don't want to withdraw money in March 2020. You don't want to withdraw money in December 2008. Those are not the times to withdraw money. Those are the times to just stay put and let the money just come back up. So those kind of, I think those are the two tools that we use that we suggest that retirees can use to have a much stable and much long-term successful retirement plan.
Sandeep, your views?
So from my side, definitely my opinion will be colored since I work for a bank. And I would rather comment in terms of as you age, there are certain sections of your age where you can take aggressive investment options. But as I think you retire, more and more allocation should go towards GICs as well as debt-heavy mutual funds, which basically take the equity risk out, because the equity risk is something which is taken well during your earning period. So you don't want to lose money on the equity side after retirement. So my recommendation will always be that move to safer investment havens as you retire.
Trevin?
So I definitely agree with that in terms of GICs and tech-heavy mutual funds. What I think will be very interesting for a number of retirees is what happens with healthcare in all countries, and also pharmaceutical care as well. And there might be opportunities there also for investing and for potential growth too, in terms of sectors as well. We're certainly going to see a pretty big push for greater healthcare coverage, potentially pharmaceutical coverage as well for Canadians. And certainly we know that one of the highest costs for healthcare are costs get higher as people get older. And so certainly retirees, that will have an impact on them. But I think to your original question, people, I mean, what is going to be really interesting too, you mentioned that the labor force is going to be older. There will be more retirees than people in the workforce. I think specifically for Canada, and we haven't talked about this enough in this country, is the impact on lower immigration levels on the Canadian economy. For the past few years, the Canadian economy has been growing mainly because of immigration, because we've been adding more people to the economic base than it has because of productivity, which is a whole other problem for the Canadian economy too, right? Canada's always had lower productivity levels than the US for various reasons. But since around 2011, our productivity levels have been diverging. The US, it's been going up, and Canada's basically been flatlining. And it's because the US has put in place policies that encourage investment in the technologies and skills that improve productivity, right? That improve output per unit of input, while Canada hasn't necessarily followed suit just yet. And that should probably be a big focus of an economic recovery plan. But if we don't have the same levels of immigration, not because there's probably a will to have the same levels of immigration, it's just, being able to travel internationally or to move to another country, like it might be out of our hands right now. And this is probably going to have a significant impact on the Canadian economy.
Fair enough. Yeah. So that brings us to the last segment of the webinar, which is a Q&A session, which is more or less what we are doing right now anyway. But this is a formal Q&A session. So I have got 3 questions to ask. And the first question is, although Amit and Sandeep have touched upon it indirectly on some of these questions, some people are saying that buying or investing in tech companies or in tech stocks may be a good investment right now, as everything seems to be going digital, online, you know. So what are your views on it?
So I will go first on that. So I've just written research on this. Top 5 tech stocks now account for 25% of US market cap. They account for 10% of global market cap. So what happens is that, and I had a quotation in my presentation, that a smart investor should buy from pessimists and sell to optimists. So there is super optimism right now behind tech stocks, and that is getting reflected in their prices. Everybody's working from home. We are all we are all paying to these services, and that's what makes us feel that this is the place to be. And there's nothing wrong in it, but at what price? And I think that a lot of positivity is already baked into the price. I'm not saying that they will crash, but I definitely think that most of the future profits have already been baked in and have already been realized in the current prices.
Okay.
So I fully agree with what Amit is saying, but I'll still add further in terms of anything which is directed towards the web, which makes the access web-based and more internet-based. I think those technologies will do much better. Like all these web service companies which are offering spaces or access to web, I think they're doing extremely well. And any equipment which is used to create that access, those equipment companies are doing very well. So any prop trading platforms or prop technologies which limit access to certain closed user groups, I think they are not doing too well. So I think in tech also, anything related to web is doing very well.
Like obviously, you know, while we are talking right now, guess who is making money? Zoom.
Yes, you're right.
No, yeah, Trevin.
Yeah, I agree 100% with what was said. I think it's not like, look, I'm pretty bullish on the prospects of the tech sector, but the real question is whether the value meets the price if you're going to invest in it. And you know, I would say that probably right now people are looking for places to put their money in, and the price of tech stocks might be higher than what the value is. It's not necessarily reflected in the price right now. And so as an investment, that's, you know, an interesting question to ask ourselves. But also anything web-based will absolutely, you know, there's going to be a big drive for that too. And I think what's driving a lot of that is businesses adapting to the new normal. You know, having to find, you know, we've done a survey in partnership with Statistics Canada, the Canadian Survey on Business Conditions, asking businesses of all types what they are doing to adapt, if they are trying to adapt. And the amount of businesses that, you know, talk about experimenting with working from home when they never have before, talking about trying out e-commerce when they never have before, you know, talking about using new forms of advertising or reaching new customers, particularly with social media when they never have before, is probably the highest ranking for how businesses are looking to adapt. And so there is a big opportunity there. And I do think that is probably more of a long-term trend than a short-term blip just because of COVID. It's just been accelerated because of COVID. And so you know, over the long term, I'm pretty bullish on the sector.
Sure. So Canada has been known as a resources-based economy, but the focus these days and going forward seems to be on moving away from oil and gas. So as an investor, is the Canadian energy and resource sector becoming a no-go zone already?
So people like, I would say that oil and gas is essential, though I think we measure everything in terms of people movement, but goods movement is also very critical. And we are seeing the movement of goods and trade continue to be important movers of global economy. So there could be some hiccups in terms of resuming people travel, but I think oil and gas fundamentally remains a critical sector of the economy, and the demand will pick up. I am not like saying it's a no-go zone. 100%. I think you should continue to watch these companies. I think low-cost producers in the first or second quartile of the Canadian oil and gas, I think will do very well once the economy picks up.
Okay.
I agree. I agree as well. So I think there are a few different factors at play. First of all, the size. So I think very large energy companies will do well. They have the margins to survive this until prices go back up, and I do think that demand will come back. Some of these smaller, medium-sized energy companies, along the supply chain, they might face more challenges just because their margins are smaller, and being able to survive this will be harder for them, as it is with many smaller businesses, but specifically in that sector. But I do think that demand will come back, or rather, I think that when demand does come back, it won't be able to be fully met by the amount of renewables that we're able to produce. And so there's a pretty robust future for the oil and gas sector and the energy sector. And also, we should talk about where demand is coming from. I mean, a lot of the demand is going to be coming from China, for instance. And certainly renewables is a big part of their energy strategy. But even just being able to displace coal with oil will help them reduce emissions as well. And so I think that there's still an opportunity there.
Yeah, I totally agree. When we look at energy companies in Canada and the valuations that they are at, like some of them have zero debt and they are at 4 times cash flow, 3 times cash flow. So those are ridiculous values for some of these companies. And the investors will sooner or later realize that there are these pockets of opportunities within Canadian energy space. And a lot of these companies are also becoming technology leaders within their own right and exporting technology and exploration to other parts of the world. So I think that's a sector for Canada, where technology is renowned world across in mining, in energy exploration. And that is going to help us, just not be a price taker, but, a technology leader in this sector.
Okay, so the last question is, real estate has always been considered a safe long-term investment, and in many senses, I mean, it drives the Canadian economy for the last many years. Direct, indirect jobs and businesses that rely on real estate. But with the super inflated prices of today in most major cities, and the talks of a bubble going on for I don't know how long. How important should real estate be in one's investment plans and portfolios?
So, Vipul, I actually wanted to have that question, but it slipped my mind. But yes, see, we were discussing with somebody who is a big investor in the commercial real estate. And what we are seeing as a trend, I can see offices, we are all operating from homes, and our residential real estate has actually become our office. So this whole concept of a home office, which was, I think, by force, I think going forward it will be by choice. We'll be operating. So residential real estate is going to see a full reset in pricing across all markets because your home is going to be your office. And for kids, I think it is going to be their school, it is going to be their university because they're going to study online. So I think residential real estate in core centers will continue to have inflation-led price surge. But yes, commercial real estate, I think there will be some resetting in terms of both demand as well as pricing.
Yeah, I think taking on the residential real estate, I totally agree with Sandeep. It's a sector we have seen that has bounced back very, very quickly. Uh, and what also happens is that, as you said, Vipul, that the prices are always out of reach. So if you're living in a city like Toronto or GTA, and to maintain balance between your financial portfolio and your real estate portfolio, though when we look at textbooks, we generally say your house should not be looked upon as an asset, as an investment asset. But when you're living in these large cities, the value of your house or the amount of money that you're putting towards your house is actually at the cost of not saving enough towards your financial portfolio. And that is leading to a lot of, when we look at Canadians in general, we look at a lot of indebtedness. We look at very, very few people with sustainable financial portfolios for their retirement. A lot of people are starting to save at the age of 45 or at the age of 50. So I think one aspect of real estate for Canadians could be to see how they can balance their real estate plus their financial portfolio. And I think especially for people living in large cities, that's a big, big question. And that needs a good strategy around it.
So I know that we're rapidly running out of time, so I'll try and keep it short. But on residential, I agree completely. I would also mention the factor though of that immigration and how that contributes to demand for residential real estate within Canada too. And so some of the impact will depend on what's done there. But you know, we've already seen a rebound in real estate, and we saw quite a bit of pent up demand even while the restrictions were put in place too. That was then released afterwards. So you know, I definitely think that there's an opportunity there. But on commercial real estate, you know, there will probably be some businesses that do decide to use different models, or some of those sectors that I mentioned that were most impacted by the pandemic. You know, they won't necessarily be looking for commercial real estate at the same level that they used to. And so that will definitely have a negative impact on the sector.
Okay, so anything you all want to add, maybe that I missed before I give my closing remarks?
No, I think we are good with it.
All right, so that brings us to an end for this session. Thank you to all our speakers and all the participants who are watching via Zoom or on Facebook Live. The session will soon be posted on both our websites, on the Canada India Insight YouTube channel, and covered in the Canada India Insight September edition coming out next week. Thank you to all our partners and sponsors also who support these platforms, including ICICI Bank, Seneca, Tangentia, Surti, and Hillsdale Investment Management, INC. So have a nice day and see you all soon in the next episode.